Good evening, members. First of all, I welcome CA Paras Savlaji, our today's speaker on tax audit practice session. 6 commonly found irregularities in form number 3CD. He will speak on clauses 22 to 31. I also welcome CA Pranav Apteji and CA Ajinka Ramadevji, Secretary Pune Branch. I also welcome C. Anita Suneja ji, Secretary of our TAQRB, and I also welcome all the members watching this our today webinar. So, my dear fellow colleagues, I welcome you all in a very important webinar from the series on tax audit practice 6, that is commonly found irregularity in form number 3CD clauses 22 to 31. Today we are going to discuss the commonly found irregularity observed by the board during the review process in the form number 3CD. As you all are aware, reporting details under form number 3CD are important and crucial from the viewpoint of allowance and disallowance of various amounts under the Income Tax Act. So it becomes the matter of utmost importance to conduct the tax audit cautiously and report the details appropriately. As the tax audit report certified by a chartered accountant is being referred by the Income Tax Department to assess the true income of the assessee, the role of chartered accountant in conducting the same become vital. The clauses covered today are from clauses 22 to 31 of form number 3CD. In these clauses, some of various sub-clauses are very important from the audit and reporting point of view. Continuing its effort to improvise the quality of tax audit, TAQRB bring out the webinar which will help and guide members in enhancing and improving the quality of tax audit. Our today's speaker for the webinar is CA Paras Savlaji for sharing his insight on the topic. Now I would like to invite CA Pranav Apteji to introduce today's session. I am confident that today's webinar will be a valuable addition to our professional audience. So, Pranav ji.
Thank you so much, sir, for giving me the opportunity for the introductory remarks. I welcome all the participants. I also recognize the presence of Dr. Raj Chawla, Dr. C. Raj Chawla ji, Chairman, Tax Audit Quality Review Board, Central Council member, and our today's eminent faculty, C.A. Paras Chawla ji, who has been the prolific speaker all throughout and having a very rich experience about the subject. As far as a tax audit quality review board is concerned, this board is typically set up in order to enhance and improvise the quality of tax audits that is being conducted by the members, that is the chartered accountants who is signing the form 3CA or 3CB and 3CD. So this is typically a very great initiative by ICAI, which typically takes care of all the various important aspects of clause number 3CD. I welcome CA Paras Chawla ji. I think he needs no introduction, but I'll just briefly introduce him to all the participants. CA Paras Chawla ji is a fellow member of Institute of Chartered Accountants of India. He is also associate member of Institute of Chartered Accountants of England and Wales. He holds qualification as registered valuer of IIIB, insolvency resolution professional, business and financial professional, and diploma in information systems audit of ICAI, certified fraud examiner, and also he is a commerce graduate. As far as professional experience is concerned, he has an experience of over 2 decades. He has advised several corporate and non-corporate entities on domestic taxation, international taxation, investment into India, out of India, restructuring of transactions, so on and so forth. He is well versed with Indian regulatory environment from investing and structuring perspective. He has also advised various non-profit organizations on the regulatory and taxation matters. He is holding various positions such as he is a vice president of Indo-Belgium Luxembourg Chamber of Commerce and Industry. He was the president of a Chamber of Tax Consultants during 14-15, and a CVO Chartered and Cost Accountants Association in 13-14. He was a member of Managing Committee of IMC, Chamber of Commerce and Industries, and he is on the board of various NPOs. So welcome, CA Paras Saulaji, and I'm sure that today's topic is covered, rather the clauses that we are covering is clause number 22 to 31, and I'm very sure that today's prominent speaker will give a very insightful session. Over to you, Paras, sir.
Thank you. I thank Chairman C. Raj Chawla ji, who is the Chairman of TAQRB, CA Anita Suneja ji, Secretary of the Tax Audit Review Board, and thank you, Pranav, for the kind words.
Thank you, sir.
I'll share my screen.
Yes, sir.
Is my screen visible?
Yes, sir.
Yes, sir. Please continue.
Thank you for giving me opportunity to speak on the topic on the tax audit report. This the flavor of the season at this moment. Everyone is busy with the tax audit report, but at the same time, there is onerous duty which has been casted on the chartered accountants for the tax audit report, and I really congratulate the chairman, CA Raj Chawla ji, for taking this session and educating the members on the topic. What are the common errors? How one should take care, so that as a professional we are doing the right duty for the all the stakeholders involved in this process. The clauses which are going to be covered are let us start with the first clause, which is related to the amount of interest payable under the Section 23 of MSME Act. To safeguard the interest of the MSME, government has made various amendments from time to time. They passed the act which is called the Small Medium MSME Act, and the Section 23 of that provides that the interest is payable if the amount is not paid to the if the amount is not paid to the MSME on time, the interest will be payable, and the interest has been provided by the Act itself. So, irrespective of whatever the agreement between the parties is there, the interest is required to be paid. And when the Section 23 also puts that it's a notwithstanding clause in the MSME Act, which says if any interest is paid by the buyer under this Act, shall not be allowed as deduction for the purpose of computing income under the Income Tax Act. So, who are covered here? The entities which are registered under the MSME Act are only covered here, and that too only micro and small units and not the medium units. So, units which are which are micro and small, Section 23 applies to them, and the units which are medium and other units will not be covered under this Act. The Section 16 also of the MSME Act, which says that date from which the interest is payable and the rate at which the interest is payable. So these are the provisions which, as a tax auditor, we should be keeping in mind how this should to be taken care. If in case there is nothing provided under the Act, nothing provided under the agreement between the parties, the maximum period within which the payment is required to be made to the unit which is registered MSME Act is 45 days. And the agreement can't be there for the period which is exceeding 45 days. It can be a lower period, but not exceeding the 45 days. MSME Act also provides that whenever any services are procured from such small and medium enterprises, financial statement of the entity should reflect the following information: principal amount and interest due thereon, to be shown separately, remaining unpaid to any supplier at the end of each accounting year. The amount of interest paid to the buyer in terms of section 16, along with the amount of payment made to the supplier beyond the appointed date during each accounting year. Amount of interest due and payable for the delay in making payment, but without adding interest specified under the Act. So whenever payment is made, which is delayed payment, but no interest is paid within that period, that is also required to be specified separately under the Act. Amount of interest accrued and remaining unpaid at the end of each accounting period to be specified, and amount further interest remaining due, payable even in the succeeding years until such date when the interest dues as above are actually paid to small enterprises for the purpose of disallowances of deduction under section 23. So these are the disclosure requirements. These disclosure requirements are coming from the MSME Act and not under any law. So this is applicable even to the proprietary concerns, it applies even to the partnership acts who doesn't require the audit, statutory audit under specified laws. So in that scenario too, the financial statement of such proprietary concerns should have the specific disclosures, otherwise there is a violation of the law. So if there is no disclosures made by the auditee in the financial statements, as a tax auditor required to qualify the report in the form 3CDB, and which says in addition to what is requirement under clause 22 of the form 3CD. So in case no interest is provided or no interest is paid, then you may write the nil amount under clause 22, but the appropriate disclosures are not made as per the MSME Act, then the qualification is required to be made in the form 3CB. Whenever SSE pays and claims the interest, which may be in the subsequent year, the appropriate audit procedures need to be made by the auditor to identify such claims and disallow it. It can be possible that the SSE is following the cash system of accounting, and in such scenario, the interest provision may not be required. But when the SSE is following mercantile system of accounting and not providing the interest, may affect the true and fair review, and appropriate qualifications is required to be given by the auditor in this scenario. So in short, though the clause 22 requires only the disclosure of interest which is not been paid, which is paid or not paid by the assessee, and that requires disallowances. But provisions of the MSME Act required to be kept in mind. Disclosures as per MSME Act is required to be made. If no such disclosures made, qualifications required to be, auditor is required to qualify the Act provisions. Even if no provision is made for interest, then the true and fair view is affected. So every time the tax audit quality review board comes out with a publication with respect to compliance in reporting of tax audit report. With respect to this clause, the TAQRB board has came to observations that while reviewing the various tax audit reports, it is observed that where auditee has provided for or paid any interest payable under the MSME Act, as per auditor financial statement, same was not reported under this clause as amount so inadmissible under section 23 of the MSME Act. So they observed that there is some provision in the audited financial statements, but appropriate disallowances has not been identified by the tax auditor under the clause 22 of the Act. 22 of the tax audit report. We now move to the next provision. And the participants who ever have a question may note down those questions or put it in the chat box. At the end of a session, I will try to cover those two questions and we deal with each of them. There is another provision which is a clause 23, which says that what the persons who are specified person, what are the particulars or the payment made to those persons need to be identified and mentioned under this clause 23. So the specified persons are what is specified under section 40 capital A bracket 2 bracket small b. List of the persons are there. So in case of a individual, relative of that individual, and relative is defined under section 214 of the Act, which is need to be considered here, and not the definition which is be considered under 56 2 section. In case of assets in the company firm, AOP, HUF, being director of such company, partner of the firm, member of the such AOP or HUF, or relative of such director, partner, or member need to be specified here. Any individual who has substantial interest in the business or a profession of the assessee or relative of such individual. A company firm, AOP, HUF having a substantial interest in the business profession, the relative of such director, person, member carrying out such business who has a substantial interest in such company. So we don't only consider directors or members of such institution, but the person who has a substantial interest in such entities also need to be considered, besides the directors, members, and so on. The person who has substantial interest, in case of a person who is a individual, as well as the person who holds a 20% of the capital of a company, is said to be a person having the substantial interest, or person who is entitled for the profits of such enterprise or such a unit or such business which exceeds the 20% is considered to be a specified person or having person having a substantial interest. The clause 23 doesn't require the auditor to specify what is the disallowances or whether the amount is excessive or not, because the 48(2)B empowers the assessing officer to provide for the disallowances if such payment is made which is in excess of the which is in the excess of the correct amount, or you are not required to give any comments whether amount is excessive or reasonable or not. You just need to mention only the payments which are made to the specified persons, which is mentioned in the section 48(2)B. The guidance note of institute has been provided the various steps to be taken by the auditor in order to claim to see what audit procedures is required to be followed. So, who are specified persons? At times, assessee may not disclose it to the tax auditor. Tax auditor can rely on the representation made by the assessee that these are the specified persons. Because in respect of a trust, there is a circular which is issued by CBDT. Because there is also a provision when the payment is made to relative of the or author of the trustees of the trust. The circulars mention that the list provided by such trust can be relied upon. Taking reliance on such circular, here tax auditor can rely on the assessee to obtain the list of the person who are the relatives or who are the specified under section 48(2)B. Because it becomes practically impossible for the auditor to identify this specified persons. You may be able to find out from the names certain parties, but at times such names also may not be very clear whether they are the persons who are specified under section 48(2)(b) or not. The working paper is required to be whatever act which is being done by the auditor. We need to maintain the working paper. The working paper should capture the details of the name, PAN number of this person, relationship of that person with the owners, proprietors, partners, directors, members, date, and a payment made, and such other information which will satisfy the auditor to comply with the provision of the section 48(2)(b), read with the clause 23 of the tax audit report. The tax audit review board has came with certain observations which says that in certain cases, name and PAN number person specified under section 48(2)(b) were not reported. In certain cases, amounts were reported under this clause did not match with the amounts as mentioned in the annual report. In certain cases, consolidated figures were reported instead of the respective transaction and respective person as specified under section 48(2)(b). The related parties, there are various definitions and different laws. For example, in case of company, there is accounting standard which relates to the related party. So disclosure with respect to such person is also made in the financial statement. But for the purpose of section 48(2)(b), the related party or person, specified person is only the person which is specified in the section 48(2)(b) and no other person. Whenever you identify these people, you need to check with the disclosures made in the notes to accounts of the company or any of such assessee, whether there is a congruency or there is a matching of the amount which is specified under both of these clauses. In case of discrepancy or in case something is mentioned in the tax audit report is not covered, which is already mentioned in the related party transaction of a company, then that's a sorry figure for the tax auditor, and this can attract the unintended consequences at the institute level. There is a provision, clause number 24, which says that certain profits are be deemed profits under the section 32AC, 32AD, 33AB, 33ABA, or 33AC. Those clauses, the auditor is required to specify what is the deemed profits under this act. Section 32AC has been discontinued with effect from 1/4/2018. Hence, for the current assessment year, there won't be any disclosure made under this section. In respect of section 32AD, the allowed deduction for investments in the new plant machinery in the notified area in the state of Andhra Pradesh, Bihar, or Telangana, or West Bengal, in case the assessee sets up undertaking there, or commences the manufacturing after 1/4/2015 and acquires and installs a new machinery between 1/4/2015 and 1/4/2020 in such a notified backward area. The provision of 32AD was introduced, if I'm not wrong, with respect to the damage which was caused by the cyclone in these states, and in order to encourage the rebuilding these enterprises or encourage the manufacturing activity in this region, the provision, exemption provision was brought in that picture. Deductions allowed sum equal to 15% of actual cost of such new asset for the assessment year relevant to the previous year in which such new asset is installed. Auditor is required to report the deemed profits which is chargeable under the profits and gains of business in respect of circumstances which have been specified in subsection 2 of section 32AD. The another section which is there is 33AB, which is respect deduction for the tea development account, coffee development account, and rubber development account. The auditor is required to specify the deemed income chargeable as profits and gains of business under circumstances specified under section 4, 5, 7, and 8 of this section 33AB. I'm not going in detail of these provisions. As such, these are very limited applications. In view of that, I'm not just giving the highlight of these sections and not going in the details. The another section 33ABA, which respects to site restoration fund, and if SSE has claim with respect to interest credited to such a special account or site restoration account, utilization withdrawal thereof for the purpose other than the specified purpose shall be deemed to be income, which is chargeable under section 5, 7, and 8, subsection 5, 7, and 8 of section 33 ABA. The other section 33 AC, with respect to the allowed deduction respect of reserve created out of the profits by the SSE engaged in the shipping business, and such reserve is utilized for the purpose other than the specified purpose, then there is a taxability under the clause 3 and subclause 3 and 4 of section 33 AC. However, this such reserve is required to be created on or before 31st March 2004, because thereafter the tonnage tax has been introduced under the Income Tax Act, where the shipping company can determine the profits as per the tonnage tax regime which has been introduced. Hence, this section lost relevance to that extent. So, clause 24 requires one disclosure of amounts of deemed profits and gains under section 32 AC, 32 AD, 33 AB, 33 ABA, or 33 AC. Now, coming to the next section, which is the section 41. 41 section, which lays down that if SSE has claimed any deduction with respect to the allowances or deduction claim in past, and that amount is recovered by the SSE subsequent year, that shall become the income of the SSE in the year in which such amount is recovered. It can be loss, expenditure, or trading liability incurred by the SSE. If no allowance or deduction is claimed, then the provision of section 41 are not applicable. So if, for example, there was certain expenditure which was made, but while making accounts, this was disallowed while computing the taxable income. And when such expenditure is disallowed and SSA recovers that amount, in that scenario, that since the amount was not allowed deduction in past, the receipt of such income is not taxable under the section 41. 41 has various subsections. So currently what we are dealing is 41.1. It may also happen that the SSE has claimed deductions of some expenditure in past, and thereafter, because of the corporate action like amalgamation, demerger, or new entity or the succession of business by the new person, and the original SSE is not in business and the successor is in the business. The section has provided that whenever such income is arising under section 41, it will be chargeable in the hands of the such successor of business, even though the predecessor is not in business. Sometimes it happens that there is a unilateral act by the SSE for writing of such amount. Originally, there are some precedents which say that such unilateral act will not attract the provision of section 41.1. In view of this, the act was amended. It is now provided that even though there is unilateral act by the person, by the SSE, any such remission or cessation of liability will become taxable under section 41.1. Everyone is aware that there is a law of limitation, and as per section 5 of the Limitation Act, the SSE, if the person doesn't claims the amount within the period of 3 years, then the law of limitation will apply, and that such person will not be able to legally claim that amount. It may so happen that the amount is mentioned in the books of accounts, but assessee is not paid such amount, and that such amount becomes barred by limitation, even though amount has become barred by limitation, but no right back is made by assessee. In that scenario, the section 41(1) will not be applicable, and such amounts will not become taxable, even if the such amount is barred by limitation. Section 41(2) is there, which provides that chargeability to income tax. The business the previous year in which money payable for building, plant, machinery, furniture engaged for generation or distribution power is sold, discarded, demolished, or destroyed shall become the chargeable to tax. So 41(2) is pertaining to the power generating units. 41(3) is respect to the assessees who has incurred a capital expenditure or for the purpose of asset used for the scientific research. And if such asset is sold subsequently without using for scientific research, then that will become taxable under section 41(3). But when the asset is used for scientific purpose, for scientific research is completed, or there is no further use of such asset and asset is sold in the market, in that scenario, 41(3) will not come into picture. If any excess is received by the assessee, it will be charged to tax under section 50 of the Income Tax Act. 41(4) with respect to the bad debts. So 36(1)(7) provides that the assessee can claim the bad debts in the books of account by writing off such debts in the books of accounts. And when once written off, it's allowed a deduction in the hands of an assessee. But when such amount is recurred subsequently, it will become taxable in the hands of the assessee in excess. Suppose there is a bad debt 100 rupees. It has been written off in the book, say 80 rupees, and assessee received 70 rupees. So then 70 rupees will become the income under section 41(4). Instead of 70 rupees, assessee receives 90 rupees. Deduction was claimed for only rupees 80. So the disallowance which income will be considered only to the extent of rupees 80, and 10 rupees which is excess received over and above the amount on which deduction was claimed shall not become taxable under section 41(4) because no deductions allowed in respect to the such amount. Subsection 4A provides that any amount withdrawn from the special reserve fund with respect to 36(1)(8), with respect to the financial institutions, this respect, and that amount is withdrawn from such reserve, it will become taxable in the section 41(4) capital A. (41)(5) provides that whenever such amounts which are claimed as deduction in past and received subsequently, it will be allowed to set off against the business income or losses which are incurred in past, other than the speculation business. So if the losses have been incurred in past and assessor recovers such amount in subsequent year, same will be allowed to be adjusted, income will be allowed to be adjusted against such losses. You all are aware that as per the provisions of the Act, such carry forward and set off of losses is allowed only for the period of 8 years. So only for the specific period of 7 years. But for the purpose of this section, 41 5 doesn't restricts that the period of limitation here. It says that deduction is against that income. The income can be adjusted against such expenditure which is incurred in past, irrespective of the number of years that has lapsed from the when the loss was incurred or suffered. The TAQRB has observed certain observations in respect of such audit reports which is reviewed by them. They have observed that tax audit report amount mentioned in annual report, which is chargeable under section 41 and reportable under this clause, were not reported in many cases. It is to be noted that as per guidance note, same is required to be reported irrespective of the fact whether the relevant amount has been credited to profit and loss account or not. So even if such amount is not credited to profit and loss account, and the appropriate disclosure is required to be made by the auditor under this clause. There is another clause which is 43B, which consists of the various subsections in this A, B, C, D, E, F, and G. It provides that any sum, any tax, duty, cess, fee, whatever name called. So what the section 43B says, that expenditure will be allowed only when the payment is made by the taxpayer. It says that even the amount which is provided as of 31st of March, but the payment is made after 31st of March, but before due date of filing return of income under section 139(1), same will be allowed as a deduction. Thus, this provision applies to certain sums of expenditure, which is for cess, tax, duty, fee, whatever name called, under any law for time being in force. We have observed many times that as on 31st March, there is also provision made for the TDS. And the tax auditor also, under this reporting clause, discloses the amount of TDS which is not paid by 31st of March, but paid before due date of filing return of income. In my view, such TDS amount is not covered here, and the provisions of the section 43B are not applicable to the TDS provisions. So there are separate set of provisions like 40AIA or 40AIB, which provides that when the TDS is not deducted, or if after deduction not paid, the expenditure against which such TDS is being deducted or is to be deducted will be disallowed under the provisions of the Act. Any contribution to the provident fund or superannuation fund or gratuity fund, which is set up for the welfare of the employee, deduction is allowed only if the payment is made before due date of filing a return of income with respect to the provisions made on 31st March of that year. If any sum is payable as a bonus or commission, which would otherwise be payable as a profits or dividend, such it has not been, and same amount is not been paid, the provisions of section 43B will apply here also. Any interest on borrowings, which is borrowings made from public financial institution or state financial institution, state industrial investment corporation, will not be allowed a deduction in the year the payment is not been made. Similar provisions also there with respect to the interest payable to NBFCs. Those NBFCs can be normal NBFC or systematic important non-deposit taking NBFCs. And so any interest payable to NBFC will be allowed only in the year in which payment is made or before due date of filing return of income, interest is paid. Same thing applies to the scheduled bank, cooperative bank, other than a primary agriculture credit society or primary cooperative agriculture society or rural development bank. Any leave salary has been paid to the employee is also covered under this section. Payment to Indian Railways for the use of railway assets is also covered. Recently, the privatization has been made in railways, and the assets of the railways are used by the taxpayer. So it has been provided that if any such payment is made for the use of assets on the railway, this allowance will be made. If not paid during the financial year or the due date of filing return pertaining to that financial year. It may be noted that assessee also makes advertisement in the railway trains or on the hoardings which has been displayed on the railway station. So whether disallowance will apply with respect to the such payment towards the holdings. In my view, since the such holdings are not the assets, not the payment, payment is not towards the use of railway assets, so that will not be covered in section 43B. The new entrant has been in this family is the payments to the MSME, if paid beyond the specified limit. But this provision applies only from the financial year beginning from 1st April 2023 and not to the previous years. So this will apply to the assessment year 24-25. What are disclosures required to be made? All payments with respect to the clauses which have been mentioned here, which have pre-existed on the first of the previous year, but not allowed in the assessment year or the previous year or incurred in the previous year to be reckoned here. The reporting requirement in section 26 capital A subclause small a that says that liability which is pre-existing the first of the previous year is allowed as deduction if paid within the previous year. No deduction is allowed if on such liability which is paid after the 31st of March but before due date of filing return of income. In short, the opening provision which is there will be allowed as deduction only in the financial year in which payment is made and not otherwise. In other words, the payment on which provision has been made as on 31st of March of that financial year will be allowed a deduction if that is paid before the due date of filing return of income. However, that deduction will not allowed if the amount is not paid before the due date of filing return of income, but will be allowed deduction in the year in which the payment is made. The clause B of 26 capital B says that investment liability which was incurred in the previous year is allowed to the extent it is paid on or before due date of furnishing return of income under section 139(1). So these are two different disclosures required under the clause 26 capital A and 26 capital B clause A. So with respect to this, there is a auditor need to identify what are the expenditure as envisaged in the section 43B A to G are there, whether that payment has been made during the financial year. If not made but provision has been made, whether that provision is paid before due date of filing return of income. If not paid before due date of filing of return of income, whether such amount is appropriately carried forward by the tax auditor in the form 3CB. Otherwise, what will happen is the amounts are not carried forward appropriately in the form 3CB. Subsequent year, whenever there is recovery of the things, the assessee may not be able to claim appropriate deduction or appropriate relief under the Act. Next provision is respect to the clause 27 small a. This relates to the settlement credit which is recorded in the books of accounts on that. As such, now settlement credit arises out of the our central value-added tax credits, which has been used the word, arises out of the excise duty, CST, etc., which require to be disclosed here. But these taxes, with the invent of GST 6 years back, all these taxes are subsumed under the GST Act. Whether the central value-added tax will include GST or not, as per the issued guidelines, guidance note specified that appropriate disclosures, no GST has not been specified here. Appropriate disclosures are required to be made with respect to the GST. So what type of disclosures is made? That what is the opening balance of such credits? How much credit is available during the year? Credit utilized during the year, closing balance. There's a specific clause with respect to the GST reporting, the clause 44. Hence the whatever amounts are reported here, this need to be in sync with the clause number 44 of the tax audit report. There's also one more requirement under the clause 14 small b, which is also required to be seen. The assessee can maintain the inclusive method, exclusive method of books of accounts for the purpose of taxes, and irrespective of the method of accounting, the profit remains the constant. But if any deviation is being made from the method of accounting, because section 145 capital A says the assessee should maintain the inclusive method and not the exclusive method. And with that adjustment, something is being made under section 145 capital A. The tax auditor also required to see that observations made under this clause 27A is also in sync with the requirements or the disclosures made under the clause 14 small b. The TAQRB has observed that the excise duty which was passed through the profit and loss account, instead of reporting yes, no was reported. The section also requires that when such credit which is there in the GST law, which is currently there, whether such credits has been passed through profit and loss account or not. So, what irrespective of the whatever be the situation, whether passed through the books of accounts or not, books of account in the sense the profit and loss account or not, same reporting is to be done, yes or no, in that format. The particulars of income or expenditure for the prior period credited or debited to the profit and loss account. So these expenses as well as income is covered under this clause. This is relevant only in case where the assessee maintains the mercantile system of accounting and not in respect of cash system of accounting. Because in cash system of accounting, the income or expense is recorded in the year in which it is incurred or received and not otherwise. So at times the provision is made in the books of accounts, say rupees 100, but ultimately when the claim is crystallized, it becomes the say 120. So 20 rupees could be a short provision, but however 20 rupees, which is a short provision, will not become the prior period item because the provision was made, liability crystallized in that year at that point of time. So even though the liability is exceeding the provision, this should not be reported under this clause 27B. Similar consideration is also required in respect of the income also, because the clause covers both income as well as expenditure. There is one more clause which says clause 28, it is with respect to receipt of any property by the assessee, which is for inadequate consideration or nil consideration. However, this is respect to the section 56(2)(7) small a. This section has been discontinued with effect from 1/4/2017. Hence, there will be no disclosure for the current financial year under this clause. This section 56(2)(7)(a) has been replaced with the section 56(2)(10). So whether in the absence of this, whether the change of section will require disclosure under this clause 28? No, because there is a separate clause which covers the disclosure with respect to 56(2), which will deal subsequently. So here we need to only stick to the section 56(2)(7)(b). Unlike when we deal with the previous clause with respect to the credit with respect to excise duty, words were used, but since the GST was introduced, a view was taken that this will also applicable to the GST, even though the wordings has not been amended in the form 3C(d). But similar analogy under this clause is not applicable. The section 56(2)(7)(a) has been replaced by section 56(2)(10). This is respect to the company in which public is not substantially interested. If the company receives the money towards the share subscription, which is in excess of the fair market value of such shares, then the excess amount what is received by the company will be subject to tax under section 56(2)(7)(b). For example, the fair market value of a company is 3 rupees and the company issues a share at par at the face value of rupees 10. So there is a difference of rupees 7 here. But since the shares are not issued at premium, same will not be taxable under section 56(2)(7)(b), because the 56(2)(7)(b) applies only when the shares are issued at premium. But the situation will be different when the fair market value is 10 and the assessee issues the shares at say 15 rupees. So 5 rupees will become taxable to the. So this section was not applicable. This is also known as angel tax provision, and this section was not applicable with respect to the non-resident shareholders. So, but from the with effect of 1st April 2023, so assessment year 24-25, so this section has been extended even to the non-resident. How to compute the taxable amount here? You need to look at a rule 11U and 11UA, which determines, which lays down the mechanism to determine the fair value of such assets, which is being received by the any person. The methodology for determining the fair value has been also been prescribed. It follows the book value method or DCF method. book value method, valuation can be done by the chartered accountant, but with respect to the DCF method, valuation can be made only by the merchant banker. The assessee may adopt a method of say book value. The assessing officer cannot change in case of subsequently discrepancies are found. Assessing officer cannot change the method from book value to DCF and vice versa. So assessing officer has no liberty to change the method adopted for the purpose of the valuation. Tax auditor may require to depend on the work of expert, that is the person who has done the valuation of shares. Auditor may not be competent to determine the value of such shares because the valuation is required to be done by the merchant banker in case the DCF method is used. In that scenario, the standard of auditing number 620, which says use the work of expert, same can be considered here while making appropriate disclosures under this clause. The amount received by the assessee with respect to the transfer of capital asset, and such amount is received by way of advance, then and such advance is forfeited in future because the negotiations has failed, become chargeable under section 56(2)(9). And for which disclosure is required to be made under the clause 29A. The clause 56(2)(9) is applicable only if the three conditions are fulfilled. That asset which is to be transferred is a capital asset. There is negotiation to transfer the capital asset. Negotiation has failed, and the assessee has received the advance. If all these ingredients are fulfilled, then only the section will apply, otherwise not. It may happen that assessee is a proprietor and he has certain personal assets also with him. So any such receipt of advance for such sale of personal capital asset is not required to be reported here. Whenever there is stocking trade and there is negotiation to sell that stocking trade, but that an assessee has received the advance and such advance is forfeited subsequently for the purpose of stocking trade, then such advance will not be taxable under 56(2)(9) income for other sources, but that becomes a business receipts and will be taxable under section 28(1) of the Act. Then capital asset for which advance is received, there is no forfeiture as such, but unilaterally recipient of that money as return of such amounts in the books of accounts. So a unilateral act for the purpose of 56(2)(9) may not be applicable, as unlike what is there in section 41(1), but even though unilateral act was there, the provisions were attracted. Here also, as a tax auditor may require to rely on the representations made from the auditee to understand the amount for feature and other things. And when the tax auditor is relying on the amounts which has been shared by the assessee, in that scenario, appropriate disclosure may be made in the books of accounts that this is based on the representation of the assessee. Just a moment. Yes, the section 56.210, deemed income, deemed gift provision, which has been introduced under the Income Tax Act. The year disclosure is required to be made whether such amount, any such amount is included as the income chargeable in section 56.210. If yes or no, if yes, nature of income, amount thereof. 56.210 is the deeming provision, which provides the different types of assets, different methods of valuation. In respect of shares, it allows you to value using the net asset method. Net asset method, along with the substitution of certain assets, like immovable property need to be substituted with the stamp duty value. Bullion jewelry has to substitute the value of such bullion and jewelry, the market value. So those are methods, net asset method, but it's the adjusted net asset method. In respect of certain types of assets, there has to be replacement in the values. Whole mechanism is provided under Rule 11 UA, and the calculations to be required to be made as per the Rule 11 UA. Section 56.210 also provides certain exemptions with respect to the certain transactions or with respect to the receipt from certain person. If the receipt is made from the relative, there is exemption provided, a relative which is defined under section 56.2 and not the relative which is under section 214 of the Act. It also provides that in certain situations, amount if received from the persons like a trust is not subject to tax. So amount received at the occasion of marriage is not considered as the taxable receipt under this section. So as and when you are conducting the audit, the auditor required to determine the amount. You need to verify the amount is received from which person and whether this falls within the exemption which is provided under the section. This is the relative or certain occasions, falls or not. If it falls within that category, then no disclosure is required to be made here under this section. This section is a very complicated section. Auditor may not be in position at times to determine certain amounts here unless until the assessee cooperates with the tax auditor. So auditor need to be very careful in this provision to make appropriate disclosure so that he is not violating his duty. Amount borrowed in Hundi, which is required to be disclosed under the clause 30. The Hundi is the negotiable instrument which is usually in the vernacular language, and the amount which is borrowed by Hundi and repaid otherwise than way of account paycheck is required to be disclosed under, which is specified under section 69D. It is pertinent to note that with the current advent of technology and the banking system, the borrowings under Hundi has reduced drastically, and in view of this, there may be practically a limited application of this section here. Loans, deposits, receipt of loans, deposits, section 269 SS, 269 ST, and 269T. It's very important section, which section says that any receipt other than by account pay check exceeding the limits which is specified under this section will be subject to penal consequences as specified under the Act. And this becomes more vital that earlier there was a tribunal decision in case of sunflower, Pune tribunal decision which says that if any book entries are being made or any transactions are happening by way of a JV, then provisions of this section is not applicable. But Bombay High Court recently has specified, or that is more stated, that even though the transactions which has been made beyond the specified limit by your JVs, the rigors of the section will apply there. But in the same decision, Bombay High Court said then the parties were identified parties, hence this transaction is not subject to the levy of penalty. But violation of sections 216 SS is not is there. Similar point also been there some other decisions of Shakti Foundation as well as the Object Frontier Software, and the SLP against the same decision has been admitted by Supreme Court. So we will come to know how the Supreme Court is dealing with the matter, whether the journal entries will be covered by this provision or not. But recently, Mumbai Tribunal in case of Macrotech developers has held that journal entries are not subject to the provision to the rigors of this section 216 SS because they said that amount post setting off with the JV, whatever balance amount was remained was settled by way of account pay check. Considering that point, the tribunal came to a view, Mumbai Tribunal came to a view that the provision of section 216 SS ST are not applicable. Reporting requirement. The clause 31A of this section requires the reporting to be, various clauses of this section are required to be reported. The 31(1) says that all loans deposits accepted in the excess of the specified limit during the previous year has to be specified here. Whether that amount is received by account pay check or otherwise than the account pay check, just reported here irrespective of whatever is the there. Then in the 31 clause B says that the particulars are specified accepted in excess of the limits of section 260 SS during the previous year has to be mentioned here. The BA, all receipts in excess of limit specified in section 216 ST, which is otherwise than your check, bank draft, or electronic clearing system has to be mentioned here. Double B says that receipt in excess of limits specified under section 216 ST by check or demand draft, not being the account pay check or account pay bank draft, need to be specified here. The subclause BC that all payments in excess of limits specified under section 216 ST, otherwise than by way of check, bank draft, electronic clearing system, need to be mentioned here. And the clause BD says that payment in respect of the limits specified in section 216 ST by check or bank draft, not be account pay check or account pay bank draft, need to specify. It becomes very difficult for the auditor whether the amount which is received by the check or bank draft or account pay or not. In this scenario, auditor can rely on the representation made by the assessee, but appropriately just to mention in the books of accounts, in the audit report, that auditor is relying on the representation made by the assessee. And since he is not in possession of such instrument, which is a bank draft and check, and such instruments are with the banks. And in view of this, the auditor is not able to verify such things, and he has relied on the representation made by the assessee. Then the clause C, all repayments. So this pertains to section 269T now. So all repayments of loans or deposits or specified advance exceeding limits specified under section 269T is required to be made. 216 SS is with respect to receipts, and 269T is with respect to the payments. Clause D says that particulars of repayment of loan deposit or specified amount in excess of the limit specified under section 269T, otherwise than by of account pay, check, bank draft, electronic clearing system through the bank. And the clause specifies that the particulars of repayment of loan or deposits or specified advance in excess of the limits specified in section 269T by check or bank draft, which is not account pay check or bank draft, is required to be reported here. The TAQRB has came with the observations that that many cases names of the person concerned from whom the loans have been taken has not been mentioned, or consolidated figures has been reported instead of the various parties under this clause. And further, they also made observation that appropriate change in language has not been made by auditors while disclosing under this section. With this, I tried to cover the clauses allotted to me, and time was allotted to me was 7:15. I have finished in the time, and now we can take up the question and answers, if any, on the topic. Back to the organizer. Ajinkya, are you there?
Hello?
Hello?
Yeah,
can you
sir.
take these questions now?
Yeah, sure. So we have received a few questions. So the first one will be, sir, can you clarify the clause 26, subsection 2, that is state whether sales tax, custom duty, excise duty, or any other indirect tax, levy, cess, impose, etc., is passed through the profit and loss account, whether it includes property tax, road tax, fitness and pollution fees paid for vehicle, employer contribution to PF and EIC, water pollution and air pollution fees, etc.
Clause, renewed clause is applicable with respect to the central levies and the and since this the taxes which is there with respect to which clause? The question is
So clause 26, subclause 2.
just a moment. I'll just see the language. The word used is the in the section 43B is the tax, says all those things, but whether everything is a tax or says need to be considered here. You see the item, the municipal tax is a tax which is there, and the provisions will be applicable with respect to municipal tax also. What are other types of expenditure?
So other are the road tax, fitness and pollution fees paid for vehicle, employees' contribution to
Fitness
PF and
and pollution
EIC.
fee, I don't believe this is a tax or a cess in my view, hence will not be covered here. Road tax,
Right.
yes, will be covered because that is a tax as such.
So even employees' contribution to PF and EIC, it's not a tax.
This is not tax which is not covered here. That is covered as other provision, PF and ESIC. So that will be not covered under the clause A as such.
water pollution and air pollution fees.
In my view, that the word fee is used, but we need to see the word fee with respect to word tax. So water pollution and air pollution may not be covered here, in my view, prima facie. But we need to see under what provisions these are levied and then come to a conclusion whether that is covered under this or not. The language of that act need to be seen effectively to come to the conclusion.
One more question regarding same clause. Whether it includes tax on purchase only or tax on all kind of expenses, as both are part of P&L statement only.
The word is not used for the purchase. It is any sum payable by assessee by way of tax. So all taxes, irrespective of purchase or expenditure, will be covered here.
So then the next question is, in the clause for contribution to any PF, etc., is ESIC covered? Because ESIC is absent in the clause.
The language under section 43B, clause B says any sum payable by assessee as an employer by way of contribution to provident fund, superannuation fund, gratuity fund, or any other fund for the welfare of employees. So ESIC will be covered under any other fund for the welfare of employees here will be covered.
Right, sir. So another query is, if assessee is an individual and turnover from intraday is 4 crore and from other business is 7 crore, whether tax audit will be applicable?
The institute is coming out with the guidance note and they revised this guidance note. The definition of turnover is been process of revision. We wait for a couple of days for the revised guidance note of 44AB. Because if I say something that may go contrary to the institute's observation.
In a situation where a company director given interest-free unsecured loan amounting to rupees 75 lakhs to the company over the last 5 years, during the year under consideration, that is AY 18-19, the company part of unsecured loan amounting to rupees 60 lakhs converted into share capital and balance outstanding amount is rupees 15 lakhs is still shown as unsecured loan. In this situation, whether unsecured loan of 60 lakhs will attract section 41(1) of Income Tax Act 1961.
41(1) will come into picture when the assessee has claimed any deduction of claim. In respect of loan, I don't see there will be any deduction would have been claimed by the assessee. The conversion of such loan into a share capital, prima facie, I am not of a view that the 41(1) will apply unless until there are different set of facts on this. Because the 41(1) is specifically use the language. I'll use the language wait a minute. The allowances or deduction has been made in the assessment year for the purpose for any year is for losses, expenditure, or trading liability incurred by the assessee, and subsequently year they received the amount. So conversion of this will not amount to the any remission of liability. There could be an issue which may arise when there is a loan and that loan is written off in the books of accounts. No, section 41(1) will not apply, but with the amendment in section 28(4), this may become taxable under section 28(4), but from the assessment year 24-25 and not to the previous years, because of our previous years, the decision of Mahindra Mills, Mahindra and Mahindra will be applicable, and this is not a taxable in my view.
So the next question is, if loan amount shown in balance sheet is less than the loan amount shown in the bank statement for NPA accounts, in such a case, is it correct to add the difference as unexplained investment and treat the same as income by AO?
This is a state in the very depends on the facts of the case, but you need to understand why the difference is there. If such difference is because of the interest and that interest is not recorded in the books of accounts, in that way it is explainable and it can't be added by the AO in the books of accounts. It can be added by the AO because the difference is explainable. If such difference is because of some receipts or by payments which is unrecorded in the books of accounts, so there may be probability that may give rise to the taxable event, but prima facie it should not give rise to the taxable event. There is a difference in the books. So reconciliation between the books and reconciliation with the balance in the books as well as the balance in the bank need to be done and identify the reason for such difference, and that will depends on the facts whether that can be added to the taxable income or not by the tax officer. Ajinkya, you are on mute. Participant bear for a moment. Seems there's some technical difficulty with the Ajinkya.
Hello, sorry, sir. This is hello.
Hello, yeah, Anita madam.
Yes, sir. There was a network issue. Sorry, sir. Sir, we can continue, sir.
Ajinkya was reading some questions on that.
Ajinkya, sir. Ajinkya, sir, are you there, sir? Just 1 minute, sir. Let me check the technical issue, sir.
Yeah.
Ajinkya, sir? I think so. There's some problem. Ajinkya, sir is not able to hear.
Either you can share questions to me directly or someone else can read the question.
Yes, sir. I'm taking the question, sir. Just allow me a minute time.
Okay.
Ajinkya, sir, can we take the question, sir?
Yeah, sorry, actually there was some issue with my Zoom this thing.
Not an issue, sir. We can continue, sir.
Yeah. Sir, the bad debts written off in the previous year claimed as expense and say subsequently it was recovered in the current year and shown as income. Is income should be reported for the previous year or of current year?
Income will be reported for the current year under the clause 41(1) and not of the previous year.
Right, sir. It says that bad debts were written off in the previous year claimed as expense and subsequently it was recovered in the current year and shown as income. Is the income should be reported of the previous year or of current year?
Correct. Income will be of current year, and if during the current year, if the business is not continuing, and if there are any losses which are there, which is not absorbed in the past, same bad debts recovery can be adjusted as that expenditure also.
Okay. Whether in clause 26, TDS and GST payable is covered under the belt of tax or not?
TDS is not covered, GST is covered.
Okay.
TDS is not a tax.
Okay. So these are the questions that we had received. Sir, in addition to that, I had the many CAs or they were asking me some queries in general, and even I would like it to be clarified from you. Now, for the tax audit applicability, when we go for section 44 AD, we say that minimum 8 or 6% tax has to be paid. So, in case there is no other business income but only a loss, so in that case, is it applicable?
The one view which is prevalent that since this amount is below taxable limit, tax audit is not applicable. But this view is not clear from doubt. The view has been prevalent very well.
So what is the view? Just can you repeat once?
The view is that since because of losses, the amount is below the income of that SSE is below taxable limit. And once the income is below taxable limit or maximum or not chargeable to tax, the tax audit is not applicable when the profits are not as per the 4480.
Okay. So this is well settled law now.
Not settled law, but that is a view prevalent going on. We don't have any legal precedence as on date on this. At least I am not aware of it.
Okay. I guess so then there are no more queries. We have now we have answered all the queries pending. So then can we move toward the conclusion of the session? Anita ma'am?
Absolutely, sir.
Yeah. So thank you, sir, for thank you, ma'am, for giving me the opportunity of giving the formal vote of thanks. Good evening, everyone. On behalf of the Institute of Chartered Accountants and Taxation Audits Quality Review Board, I stand before you to deliver a heartfelt vote of thanks for this enlightening and productive professional seminar. Today has been a remarkable session filled with insightful discussion, valuable knowledge sharing, all of which have contributed to the success of this event. First and foremost, I extend our deepest appreciation to our distinguished speaker, CA Paras Savla sir. So your expertise and passion have undoubtedly enriched our understanding on today's topic. We are grateful for the time and the effort you have invested in preparing your presentations and delivering today's lecture. I would also like to express our gratitude to CA Dr. Raj Chawla sir, Chairman TAQRB, CA Chandrasekhar Vichitra sir, Vice Chairman TAQRB, and the organizing committee of Taxation Audits Quality Review Board and the support staff who work tirelessly to ensure the seamless execution of this seminar. Lastly, I would like to thank each one of you, the participants, for taking the time to be part of this event. Your presence here today is a testament for your commitment to professional development and your willingness to stay abreast of the latest trends in the domain. We hope that you found this seminar rewarding and that knowledge gained will have a positive influence on your future endeavors. Thank you once again to everyone involved in making this seminar a resounding success. With this, we conclude for the day.
Thank you very much, sir. Thank you, Paras sir. And I will request you to kindly share the presentations so that we can share with our members also, sir.
Sure.
Thank you very much. Thank you, sir.
Thank you, ma'am. Thank you, sir.
Bye, sir. Bye, sir. Good day.
Bye.
Bye.